Good evening and welcome to Be Informed. My name is Carl Buhariwala and I founded Be Informed to help you make good decisions. Today's session is on borrowing for growth, and we have Hosseini of Aussie Home Loans and Platfio app development to present to you the seminar on finance tips to help you grow. Before we proceed, I'd like to acknowledge the traditional owners of the lands on which we're meeting today and pay my respects to their elders, past and present. And as a reminder, this session is being recorded and will be made available to you following the session on our YouTube channel. In terms of a disclaimer, I'd like to call out that this session is being presented to you in Australia and is in consideration of financial matters which may or may not be applicable to you. So if you do have any queries about this information presented to you today, please do consult a professional because the information shared today is general only. In terms of the currency of information, it's current as of today. So if your circumstances do change in the future, you may wish to reconsider the information presented to you today. In terms of housekeeping matters, we've got a few things. So if you do have any questions, feel free to share them through the chat function, and I will then relay them through to Sana. If you want to ask any questions or provide any feedback, you may do so following the session through by email to us, and we can get back to you. And the one-page handout which Sana has prepared for us will be shared following the session to registered participants by email. And you can then have a look at that in the future and also share that with family and friends for their reference. So today's will go for probably about the hour. We've got a seminar, 25 minutes, followed by Q&A. And we'll also include questions that we received by email ahead of this session at the start of the Q&A allocation, and then we'll move to the questions raised during the session. So I'll hand over to Sana now, and he can get into his seminar. Thanks, Sana.
Thank you for having me, Carl, and looking forward to hopefully being of service to whoever listens to this, and hopefully you can use some of this information throughout your life. A lot of the information I'm sharing is quite general in nature in terms of it'll actually help a lot of the considerations around finance, whether it's on home finance, car finance, or purchasing a property. These are all quite for investment. These are all quite standardized bits of information. But I thought today we can look into finance tips for growth and base that around your ability to work out things like borrowing capacity and go into a bit more detail around that. Carl, if I could get you to show us the next slide. Excellent. Okay, so we're going to get kicked straight into it because we've got a fair bit of content to cover. And the first part is gearing. So gearing is the best example that I could think of was like a lever. I think, was it Archimedes that said that give me a lever long enough, I can move the world. And essentially, purchasing a home is using a levering system or a gearing system, which means that in this bit, for example, if you went to the shops and you said, look, I'd like to buy some milk, but I'll only give you 10 cents out of every dollar. So say, if, for example, the milk is say $3, I'll give you 30 cents and I'll leave with the milk. The shop owner would be like, definitely not, that's not possible. But with a home loan, that's actually something that's possible. You can buy a home with 10% or 20% of the value as a deposit, and the rest of it you can actually borrow. And that's the power of gearing. And that's essentially what is the reason that people would want to borrow money for growth. It's that you don't need to have the whole amount of money to be able to do things. You can actually borrow a large amount of against itself. Carl, if we can go to the next slide, please. So there's a few elements here we're going to go through during the session today. We're going to look at borrowing capacity initially. So in terms of borrowing capacity, this is a distillation of how to calculate borrowing capacity, and we're going to go through it together. There are some elements to it, so we're going to go through it one by one. So in terms of the borrowing capacity, um, if you look at the initial kind of component, we've got income. So income is based on whether you're employed or self-employed, and we're going to go into a little bit more detail into that. So what we're going to do is we're going to look at the formula that I've got here for you. So say this is a couple, and we've got um, borrower one and borrower two. What we do is to do a calculation of borrowing capacity is actually only about, say, 3 or 4 lines of maths. And it's very simple. Hopefully you see it simple. Essentially, if you think about it, the uh, borrowing capacity is a factor of your income after tax. Because obviously get to keep the amount, the tax amount. So you can't really use that as in terms of borrowing capacity. So we take the tax off it, and that's the amount that's sort of left for the family. And so in this particular case, we've got $137,000 that's left for the family to use. Now, from that 137,000, we take away living expenses. Now, a really simple living expenses calculation is that we take the first member of a family is around, say, 30,000 in living expenses. And for each additional member of the family, we add five. So say if you're a couple, you go 30 for the first person and then five, because look, it doesn't need that much more light or electricity to run a home. The base level costs, as long as they're covered, you're adding on to that. So say in this case, we have a couple with one child. And so we go 30,000 for the couple, sorry, for the first person, then 5,000 for the second person, and then five for the next person. And so we have 40,000 in living expenses. And so 137, we take away living expenses and we're left with 97,000 essentially. The number that's after living expenses and tax, you just multiply it by 9, and that's your borrowing capacity. And that's a really good rule of thumb. Now, obviously, it's not exact for every single lender, but it's a really good back of the envelope or calculation that you can use to work out borrowing capacity for a family. The next, and this is a family of one child, approximately, who are earning these as incomes. Now, you may ask, okay, well, what if I've got a car loan or a personal loan or a credit card? So what we do next is we take away that from borrowing capacity. So say, for example, we've got a car loan and a credit card. We add the limits. So it's essentially what you originally borrowed um, together, and we get, say, 35,000. We multiply that by 5. And this is where having a credit card or a car loan has a huge effect on borrowing capacity. And so in this particular example, you go from being able to borrow close to 900,000 to closer to 700,000. And and that's because of credit card limits. And this is where most people say, well, we can close our credit cards, and that's definitely correct. But because the interest rates on credit cards are roughly around 5 times what a home loan is, the effect on borrowing capacity is about 5 times as well. And so, similar to a car loans interest rates are higher, and also they're compressed over a shorter period of time. And because of that compression of time, they have a larger effect on a home loan. And most home loans are about 30 years. The next little component to that is that if you have any other limits, you can just keep adding them below here. But that's pretty much it. So after tax income, take away living expenses, multiply by 9. Any other debts you have, their limits, multiply by 5. I hope that you find that calculation useful whenever you're calculating any borrowing capacity for yourself. And then you'll have a really good idea, because the calculators on the internet are generally skewed for to make it look like you can borrow a lot more just to get you in. And then they say, oh, look, because our calculator was too inaccurate, it's this number. So this is a really good way that you can go in feeling confident that you know roughly what your borrowing capacity is. Okay, next slide, Carl. Wonderful. Um, So, what we can do next is look at employee income. So, yeah, what I mean by employee income is that if you receive a pay slip, either it's weekly, fortnightly, monthly, and your salary is taken uh, as a baseline number of, um, say, $100,000, and then you have like your tax taken off it, and then you get deposited in your account the after tax number, then you're an employee, and that's it. And this is in this case, it's basically employee as opposed to self-employed. So in this particular scenario, what we're going to do is we're going to work out what someone's employee like income is. In this example, it might be, say, for example, a nurse. And say a nurse who may have a salary of 75,000. So it's not just that we can use for borrowing capacity. It's actually 75,000 plus additions. And so we're going to go through some of those additions. So if you have a look on this on the right hand side, I've given a little bit of an example. This particular nurse is a little bit experienced. They're an educator as well. And so they get a $12,000 annually, like an extra $1,000 a month, because they have to do a lot more additional responsibilities in teaching other nurses that are there. And so we call that higher duties, or it's often called higher duties in many industries. So I've included that there. Now, if you have a look at the next thing, is that nurses are often, or almost always, required to do evening shifts, which is quite like hard on the body. And so what occurs is that they are compensated for that. And in this particular scenario, I've picked 8,000. I would expect it would be around that kind of number, maybe a little bit more than that. So in that particular scenario, I've added $8,000 as because they do evening shifts, and that allowance has been ongoing for a period of time. The next one is overtime. Unfortunately, nurses at that experience level aren't as available, and so what occurs is that they have been requested to do additional overtime hours, and so that is something that can be added on because that's often we find that's something that's been there in place for a lot. First aid allowance, nurses that have maintained their first aid certificates also receive allowances for that, often if they're responsible for it. And the last one is salary sacrificing. So this is something that is available because many nurses work in public sector, and the public sector can't afford to pay at the same rates as the private sector. So portions of their income are received tax-free, and so that can be added on as well, or included in there with many lenders. Specific lenders, but again, there are many lenders that can do that. And so in this particular case, even though the nurse believes that their salary is 75,000, in addition to all the other allowances and um, overtime, their actual income would be 109,000. So when you look at incomes, you should always consider what are the bonuses that you've received and how regular they are. Have you received any commissions? So many industries are based on commissions, a lot of sales industries. Um, do you have a work car, or do you receive an allowance for traveling? Again, that can in many cases be used towards your borrowing capacity. The next one is, are there any allowances that you receive? So if there's any like tooling allowances or any specific allowances that are based on your particular employment and regular to your type of employment, they can also be included. Um, Again, any other allowances? Is there danger pay? We see a lot of people working on like a lot of like heavy duty electrical kind of work that's occurring in those cases, because they're working on high voltage or deep underground. They receive danger pay, which they definitely should receive those kind of things if they're willing to work like a few hundred not hundred, sorry, a few hundred meters below ground. They receive things like danger pay that can also be included as part of income. And the above allowances, are they regular? And if they are, they can often be included, and including also salary sacrifice. Next slide, Carl. Thank you. Okay, so next one is self-employed, which is near and dear to my heart. I'm self-employed, and I've been self-employed for the last 20 years, and I know that often it's really hard to find financiers that understand self-employed income. And so there are things that you can do to better understand your own income and be able to explain to them and provide them with the details. So in this particular, we're going to go through an example again. I find the examples are more useful, and then we can go back through to the points. So if we have a look on the right hand side, we've got a company that had someone comes to us and says, "Sanad, we had zero profit this year, but we'd like to buy a home." So then what I do is, if you look deeply into the company, you notice that, well, actually, in this particular company, the director earned 90,000, so definitely that can be included. The spouse of the director earned 40,000 from the company, because they were doing bookkeeping or assisting with the business. The next one is depreciation. So, for example, they may have bought a particular tool that was like $20,000, and they might have also bought a car that got written off in the 1 year, whereas they can use that vehicle over many, many years, or that particular tooling they can use for many years as well. And so, in that particular case, you can actually add that back to their income because it's not actually only based on this particular year. It's an asset that can be used ongoing. They also invested in an app. Apps are also near and dear to my heart, and they may have invested in an app to better run their business and or help their customers to engage with their services um, in a better way. That that particular sort of development might have been quite an investment for them, but that's actually something that can be used over many years. So again, that can be added off because it's a one-off kind of expense. And then the next thing is if, for example, they're purchasing a home and they're currently running an office and they've got a rental property. And what they can do is with this home, it might have a large backyard that they can use for storage. And they might not need the storage that they currently are renting. That can be added back onto it as well in certain scenarios with certain lenders. And if you can explain it clearly that, look, this storage will be closed, this space will be used dedicated for this, or there's a large shed on the property. I own an office that's up in northern New South Wales, which is quite regional, and we've also got the South Yarra store. So in the regional stores, that's actually quite common. So for example, there might be a contracting company that has a backhoe or has a large bit of equipment that they were previously using, a storage shed or a storage facility to house them when they weren't using them. Then they get a large home that has a large property with it, and they're able to do that at home. That actually reduces their costs. And so in this particular case, when initially you look at the company profit and you're like, okay, well, there's not much there. When you break it down, they actually have over $200,000, or in this particular case, $230,000 that they can put forward as their borrowing capacity. So, in summary, you look at your profit, but also you look at what you pay yourself and your partner, which is quite often in the case in self-employed circumstances. You look at if there was any government assistance or grants that they received. So, were there some software, for example, if it's something that no one else has ever done and it's new, you can actually claim well, you can claim it against your tax, and you can get an R&D. In addition to being able to claim it against your tax, you can also get tax credits. So it can cost it can almost be half the price. So you get a tax benefit and you get half the money back as well. So it's like a double benefit. So that can be added back. Were the expenses one off? uh, in the example of the car and the tooling that you bought. Um, can you claim back any of your rent? So previously you were renting, but now you're going to own a property where you won't need to pay that rent back. Sorry, pay that rent anymore. And um, yeah, does your new home reduce your expenses, or your new investment property reduce your expenses? Next slide, Carl. Thank you. Okay, so why do people buy investment properties? And this is something that's a, a really interesting scenario that I wanted to go through with you and just break it down because it's not often thought about, but the returns on investment properties are not what most people imagine them to be. And so I want to actually give you a deep dive into why people buy property and what the actual internal rates of return are. This may seem a little bit um, detailed or complicated, but I'll break it all down and we'll go through it together. So, if you have a look at the very beginning, we are looking to purchase a property at um, 650,000. Okay. Now, well, you may have used a buyer's advocate. So these are people that help you to select the best properties. We can recommend a few buyer's advocates that we use and trust, and we've used in terms of our family. And what they do is they have their finger on the pulse. They go to the auction, they help you select properties, all of that kind of stuff, and then for a fee. And so they're generally able to save you whatever it's cost just by the fact that you're able to make better decisions. So in this case, an advocate, a buyer's advocate. The next one is stamp duty and costs. So now this is where I'm going to give you share with you a trade secret, the number six. So if you always think of 6%, it's like the internal number that we use as a team that works out all your expenses to purchase a property. So if you think about it this way, 5% is stamp duty and 1% is all your other costs. So your legals and your registration costs. And so this is a brilliant rule of thumb. If you've ever got a property transaction that you're trying to work out your expenses for, what I would suggest is just go work off six. So if the property's say 600,000, go 6 times 6 is 36. Okay, all my expenses are going to be 36,000. In this case, it's 650, and so 39,000 will cover all your expenses to purchase the property. And you have chosen to put in a deposit of 5%. Oh, sorry, 10% here. So 10%, so 65,000 on 650. So 10%. So in this case, what your actual borrowings will be is 637,000. You may have another property that you are using as in terms of equity. So equity is a very simple thing. It's basically the value of a property. So in this case, say for example, 650,000. You may have um, a loan of say 250, so your equity is 400,000. It's the portion of the property that you own as your equity. So in this particular scenario, we're going to say that this customer has, or this borrower has another property and is now buying their next property, which will be an investment. So in this scenario, I've picked, say, $500 a week as rent. And so we've got 25,000 a year. Now you may go, well, actually, Santa, that should be 26,000. You're 100% right. But I used to be a tax accountant years ago, and so I'm always a little bit conservative. And so in this particular scenario, I've used 50 weeks in the scenario, and it also makes the numbers easier if you just go 5 times 5 5s are 25, and you can also do that kind of calculation in your own mind, and you can be really quick with it. And 52 is a little bit more difficult, but I also find that being a little bit conservative is often better. Okay, so now we go to the right-hand side, and we've got, if you look at it, we've got the loan balance. So the loan balance that we're looking to borrow is 637,000 at an interest rate of say 6%. That's $38,000 approximately. We've got agent fees. So agent fees are essentially the they charge 6.6% of the rent. And so in that case, it's around 2,500 you pay the agent to maintain the property for you. You may have rates, and again, these are all just estimates of say $2,000, insurance of 1,500, and say repairs and maintenance. It's obviously a newer kind of property, but if it's an older property, you might want to use a larger number for that. And if you have a look at this now, say 25,000 is what you've made, and after that, you've spent 46,000. There's actually a loss of $21,000. So you may go, oh, that's terrible. It's 21,000. So now we're going to go into how you should actually consider investment properties. After tax, so say if you're in the 37% tax bracket, After tax, your actual loss is only 13,500 because you can claim losses of rental properties against your other income. And so it reduces how much tax you pay. And so in this particular scenario, the actual out of pocket is around 13,500. Now, this is where it gets interesting. Hopefully, you've followed till now. If the area, so if you think about properties at the moment, we may not be seeing the growth, but what's occurred is that I don't know if you've heard this or you've had discussions, the post-COVID and supply chain issues, a lot of material costs have gone up. And if you talk to any builders, they will openly tell you that, look, building costs are anywhere between, say, 25 to 35% more because of materials, labor costs of labor, and it's just because there's a shortage of labor and the material costs have gone up. So if you think about that, every single property that's currently owned has actually gone up internally in value. So we may not be seeing that right now, but if you think about land values and the value of building that same home that you currently own, or and so there's actually this intrinsic value in properties that's gone up that not many people are thinking about. But if you think about the fact that if you were trying to rebuild that home, it would cost, say, 25 to 35% more than it cost originally, there's actually an intrinsic value increase that's occurring. Now, if we ignore that completely, and that's just a sort of a general concept that I want you to understand, and we say that, okay, well, historically in this particular area, properties have grown by, say, 8%, 7%, we may be conservative and say we estimate that it might grow by, say, 5%. That on the value of the property, so 5% of 650,000 is 32,500. Now, we made a loss on this property, but the property grew in value intrinsically over time. Now, obviously, you only see that growth at the very end of it, and so it's not something easy to tangibly see. And so we may often forget about it, but it's actually the reason that people buy investment properties, or one of the reasons that they buy investment properties. So the actual return on this property was $19,000. Um, at when you work it out purely on the actual internal numbers. And so if you say, okay, well, $19,000 and your deposit on this property was, say, $65,000, your actual return on investment is 29% annually. Now, I'm not sure how much you're receiving on your bank balances, on your transaction accounts, um, or share portfolios, or all of those kind of things. But this is the actual reason people buy investment properties. And this is not, unfortunately, it's not taught in schools. It's not taught anywhere that I know of that's not like guarded by, I don't know, financial planners or guarded by sort of people. And I hope that this sort of creates a bit of a understanding for you on why people buy investment properties. What I've done is I've actually shared this in the handouts. So if you want this breakdown of it so that you can run these kind of calculations for yourself, you can email Carl and get a copy of the breakdown on the handout sheets from Be Informed.
Thank you, Sana. That was great. Sana's details are on the slide here. So if you have any further queries about anything that is talked about, feel free to engage with him and he can help you. Just as a reminder, any sort of examples shared by Sana throughout the seminar are examples only, right? So they're all hypothetical. Don't take them as gospel in terms of if you have a property valued at 650, you're going to get the same level of return. But it's good to sort of see the breakdowns and how to think about both the capital growth and also the rental, the yield as well. We'll now move into Q&A. And just as a reminder, if you do have any questions, please send them through the chat function and I will relay them to Sana. And also a reminder, the session is being recorded. So if you have joined partway through Sana's presentation, you can always watch the start of it online on our YouTube channel. And as Sana has flagged, there is a one-page handout that he has prepared, so those that have registered to receive that will get a copy. So we'll now move on to the Q&A, and we'll start off with the questions that we've received ahead of time. So Sana, we'll just go through those first, and then we'll jump onto the questions we've got through the chat, which I'll navigate through shortly. So the first one that we've got by email is around investment properties, and you've touched on that subject as well. The key questions around sort of borrowing capacity, right, at this point in time, given property prices in some areas have fallen, and people have, and the banks, the lenders have high expectations around their interest rates. What sort of strategies can they use to negotiate? Should they engage a mortgage broker to help them out, or is it best to do it on their own?
Definitely. So there are two main ways. Well, obviously, you can go and approach your bank, but what often occurs is that there's a little bit of a loyalty tax with some lenders that if you don't engage with them and follow them up and say, "Hey, I would like you to drop the rate," they won't. So they'll maintain the higher interest rates. I've never heard in the 20 years I've been a mortgage broker, I've never heard anyone say, "Oh, my banker randomly contacted me and said that they were charging me too much and they'd like to reduce my rate." So, but what you can do is you can contact them and say, "Look, I'd like a review of my interest rates. I'm considering moving," and that is normally a trigger for them to go and look at your loan and see what's possible. Another thing is just to go onto their website and say, okay, well, actually, you're offering this rate to new customers. What can you do to get me closer to it? That's probably something that you can do personally. Better still would be if you can engage a mortgage broker to do that for you. We internally have an amazing broker. Her name's Sophie Rizaz. She's brilliant. What she does is she goes and finds what the best interest rates are for you. Within all the banks and then contacts your own bank and says, "Look, I'm going to move this person if you don't match this rate." And often we find that because she's gone in and they know that if if they don't listen to her, she will move you. Like there is no like bluffing or like yeah, she will move you. Now, some of the things to do like that are good to consider is one of the reasons we do try to go back to your own original lender first is to make sure that we don't cost you any money because obviously there are costs to refinance. So there are fees to leave your current lender and there are registration costs with a new mortgage. And so if you can get like the same rate as the best in market, like at your current lender, there's often huge benefits to remaining there. Ease, comfort, and also you're getting the same rate as what you would have. But if they don't come to the party, definitely I would suggest going and visiting a mortgage broker and yeah, getting your home loan reviewed.
Yeah, definitely. I think it's to some extent they're pretty interchangeable, right? Which bank you go with. All they're doing is just
Yeah,
finance. You might get a few perks through your wealth package or through a credit card discount or
yeah.
what have you. But otherwise, the core product, the mortgage, if you get a better rate, I think it's probably better to switch, right?
That's it. With digital money, it doesn't smell, taste any different to the other money. It's all interchangeable.
Yeah, yeah. Another question that we've got is around. Seems like the person that's written this question might be part of a young family or a young couple. How early can you enter the investment property market? Like, how much evidence would you need to have? Like, do you have to work for like 3, 4 years? Like, would banks just discount you if you're too young and don't have too much equity?
So, fortunately, this is a myth. Um, so I had so my very first property was actually my mum encouraging me. She was like, "You, I was working. I lived at home. I was 20." She's like, "You look too happy. You've got way too much money." And I was like, "What do you mean?" She's like, "Well, you should feel the same pain as I'm feeling. You should buy a property." And that encouragement meant that I walked into a bank and at the time I was with tax accountant and they saw that I was working. So the first myth is that you need to be working for many years, and it's not correct. Basically, if you're working, for example, full time, 6 months is a general kind of number with a lot of banks. Some of them are 12, but that's the length of it. With some banks, it's actually if you've got a 3 months even full time, they'll accept it. If you have switched jobs and you can show that you had 2 years prior history,
Mm.
they'll even take 1 day in the new job.
Right.
And
Okay.
so there's no, it just depends on which lender. So it's not so much a one size fits all. And this is where a, a competent mortgage broker would be like invaluable because they can direct you to which lenders can do what. They
Mm.
can actually save you in huge amounts of time. Because one lender might say, look, you need minimum 2 years history, whereas another lender might be, no, 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 you just all you need to do is have 3 months and the first pay slip. I'm sorry, in that case, you'd have a few pay slips, but just two pay slips and 3 months work.
Yeah.
Or if you've got history, 1 day. So these are all different policies of different lenders. And so if one lender says no to you because you're young, just keep trying and go visit a broker. And yeah, I know that we would love to be able to be of assistance to anyone as well.
Mm. The next one I thought I'm going to reframe as a fact or a myth, right? But big four, big five banks, are they safer to go with for seeking, borrowed funds or?
So, look, what's the safety factor? So if you think about safety factors, the safety in it, you're holding their money. They don't have yours, if that makes sense. So the first thing is that it's not like they can go, oh, we're not going to give you your money. It's essentially you're holding their money and you hold the home. So in terms of safety, the only real safety things that I've seen, obviously I've been through the GFC, I've been through like periods of COVID. What I see is that so the larger banks are a little bit more consistent in terms of it. But if you go down the second tier, they're just as consistent. So if you look at, say, the INGs, Suncorp, um, they're all like MyState that's based at ME Bank. So MyState's based out of Tasmania. So they're all Newcastle permanent. So there are banks that are second tier that are relatively secure and stable as well. And obviously, if you're dealing with a like an online bank, like we've had this issue with um, actually maybe it might be difficult to name them out. But there are banks that pop up that are online and they're like, oh, look at us. We're an online bank. We don't have to pay for branches or any of those kind of things. And a whole bunch of people go there. Then 3 months or 6 months in, because they don't have any kind of reputational risk. So the big banks have reputational risk. Like they care and they care. Like, for example, if you came out, if I did something, Aussie would have a reputational risk to go, Aussie Home Loans built its reputation over 25 years. Look what they're doing. But if it's online lender that no one's ever heard of, they can do whatever they want and they're not really mind about their reputational risk. And so they've got a lot more variableness to their interest rates. So that's probably a very long answer to that question, but essentially
Yeah.
there is a little bit,
Yeah.
but the second tier are just completely fine. But if it's a lender that you've never heard of, um, go in there with a little bit more, have a look at who they're backed by, where they're getting their funding from. And if you feel comfortable with that, then go ahead. But yeah, it's good to stay informed and be informed, as Carl would say.
That's the way. Yeah, no, I agree. I think it's important to not discount those other banks just because they're not part of the top four, five, six, whatever the new top rating is. But to always do your due diligence, I guess, to make sure that you're comfortable with the lender you've chosen. Um, the next question that we've got is just around gearing and the sort of the tax benefits that you get from it. Of course, we can't sort of give any specific advice here, but I think generally you've mentioned, the sort of the benefits that you can get. One being you can claim any losses against your sort of personal or self-employed income, and
Mm.
get the benefits through that. Are there any other benefits of gearing that that you
Sure.
might want to highlight to the group?
So you may so why would you purchase a property that's making a loss? And so hopefully that example showed that even though it's making a loss, internally the property's growing. And you often find that properties that grow more are closer towards I don't know, capital cities, because obviously you can't build more land in the middle of the city, and that land often goes up in value faster or accelerated because as people become more affluent, they want to live closer to the city potentially. That's the lifestyle that they want to choose, and so those properties are often more expensive, and so they make more of a loss than a property that might be more regional. And so I own properties in both areas, so I'm quite comfortable to tell you I've got properties up in northern New South Wales that don't grow as quickly because they're more regional, the demand for them is less. Um, but the rents in comparison to the value is higher, so you derive more of a rental income from those in comparison to the value. But you may purchase a property that's towards the city, and those properties are more loss making because there's a limit to how much you can charge in terms of rentals. And so with those properties, because they're running at a loss, that income you can claim and hence, but those properties often grow more as well. So in that example I put in at 5%, maybe a regional property might grow at say 3%, whereas a capital city property in certain area might grow at say 7 or 8%. And so that in the example, hopefully will give you a bit of an idea of how to factor that stuff in when you're making those kind of decisions in terms of gearing.
Mm.
So hopefully the worksheet will help you to be able to create your own Excel sheet or to be able to run those kind of numbers for yourself. And then if you engage a professional to be able to go through that with you to just make sure that they've verified your numbers with you.
Yeah. And we've got a question through the chat function, which is around refinancing. I think now's probably a time where people might not be able to continue on any fixed interest rates they might have secured during COVID. Might be shifting to variable now, and it might increase quite significantly compared to what they were able to get, a year or two ago. What are your any sort of tips? Do you have strategies that you might
Yeah,
consider
definitely.
with the refinancing discussions?
Yeah, okay. So this is a little tip that I can share with you. Firstly, go to your own bank. Go to the bank and ask them, what is my payout figure? So that one line, what is my payout figure? Now that's the little trigger for them that sends you off to this special team called retention. Every bank has them and every lender has them. Now retention have a greater capacity to drop your rate than any other team in the bank. And so you will always want to see if you can get in with retention because they've got the goods to be able to drop your rate. And so if you get through retention and then they won't drop your rate to where potentially the market is, then you contact a mortgage broker or another bank. But I'd probably go to a mortgage broker because generally we've got so many years experience and we know we've got our fingers on the pulse on what the best rates are and who's in the market is hungry. So if you think of some puppies, so imagine it like you've got what's a group of puppies called? I've forgotten. A litter of puppies, I'll go with. And say there's 10 puppies and say 8 of them have eaten really well, and you bring out their favorite treat and you're trying to get them to sit, and 4 of them are going to like completely ignore you. The other 4, maybe they're a little bit like hungrier. They may pay attention to you, but those 2 that haven't eaten are going to be like willing to do sit down, jump, all of those kind of things. And so as a mortgage broker, we know who's hungry. We know who wants the work, who is coming and telling us, oh, look, we'll even give you cash back to come and move across. And so, as a mortgage broker, that's essentially what we can do to assist. Um, and we can, yeah, get you find who's hungry and basically we'll get you the better deal. And that's something that's sort of possible that way. I think the last tip is that if you're coming off a fixed rate, I would be probably looking at talking to a broker maybe about, say, 2 months or at least a month before. One of the things that occurs is that the lenders, so quite logically, you can think that let's go through the scenario with you. Lenders take different times. Okay, so some lenders might take a day to process a loan, some will take 10 days, some will take 2 weeks, some will take 3 weeks. Now, often as a person, we might go, oh, look, the one that's taking one day is the best. But there's a reason they're only taking one day because their interest rates are terrible and no one's going there. The one that's taking 3 weeks is actually super busy because their interest rates are the sharpest potentially. And these are just examples. There are some lenders that only take one day and that are excellent, but I'm just giving hypotheticals. And so, not say if you're coming off a fixed rate in say 2 months' time, if you leave it say to a week or two before um, you will potentially miss the lenders that can give you the best rates. Or if you wait for them, there'll be a longer period that you're on a terrible rate once you've come off the fixed rate before being able to move to a better rate with another lender. And so that would be probably the third tip would be that um, so in order, first one, contact your bank and say the line, the special line. Look, I want to know what my payout figure is and what my fees would be. Like that's basically the secret line. Secondly, contact an excellent broker who potentially specializes in refinance. There are some brokers, like I explained, Sophie, my team, she specializes in it. Then the third one would be to at least go 2 months ahead so that you have the full gamut of lenders available to you. So, and you're also not on a bad rate while you're waiting for the refinance to occur. Because even after the first loan lender approves the loan, then your current lender has to let go of your loan. And as you can imagine, sometimes they hold on to the loans a little bit longer just to get as much um, out of you or their processing times.
Yeah, yeah. And this is probably our final question. We've got a question around depreciation. We're getting a bit technical, but is it better to buy a new property because you can claim depreciation early, or you know, the older the property is, you might not be able to claim it? Sana, what are your thoughts around that being a decision maker between new and old? Of course, there's repairs and
Yeah,
maintenance. There's so many other factors as well. But
right. So I look, this one is probably case by case. Every
mm,
single case is different. It might be an older property towards the middle of a city kind of area, or it might be a brand new property in I don't know, a mining town where they've just struck iron ore, and it's going to be the next boom area. There are so many factors that go into it. What I generally find is that new properties, I won't talk specifically about the scenario mentioned because, again, I would love to be able to connect you up with like great buyers advocate that could run through that kind of
mm,
specific scenario. But I'll give you a little bit of a tip. A new property is only new for 6 months. And this is huge. So what often happens is with brand new properties, people go to a display home, they're given a lovely drink, it's very pretty, the display area. They're told that, look, this property will be built for you in 12 or 24 months. And so, and look, at times they may give you examples of previous properties that were sold and are now so much more valuable. And so what often happens is that customers may not be as critical as they would normally be, or not as clear minded. Like, yeah. And so my big tip around new properties is look at the same qualities of properties. So, for example, if it's 3 bedroom, 2 bathroom, 2 car space in this particular suburb that's being built, look at those properties on realestate.com or Domain or at any kind of property website and look at what they're selling for. And that's the price you should be paying. You should be factoring, there should be no new property tax because a new property won't be a new property for that long, only 6 months. Um, because as soon as you move into it, it's no longer new. And so it goes into the pool of properties that aren't new. And so in terms of values, a value will estimate its value based on um, properties that are similar in terms of size. And sometimes newer properties may have smaller bedrooms, not as many like bathrooms. The kitchen may not be as sort of spacious, all of those kind of things. They may not be living rooms, so which were there with an older kind of property. So I hope I'm sorry that I can't answer your question specifically, but hopefully that gave you a bit of an idea of how we sort of look at properties, new versus old, and analyze the two of them.
Yeah, there are many variables to consider, right? So I guess depreciation is only one component that you might need to consider for an investment property, but as Sana has mentioned, yeah, there's so many other sort of, variables that do need to be taken into consideration to make a more informed decision about whether to go in and buy that new property as opposed to an old one, or vice versa. So that brings us to the end. I don't have further questions in the chat. I'll just check it again. So thank you again, Sana, for that seminar. It's been great. His details are again on screen, so if you do have any questions, feel free to reach out to him. As a reminder, this session is being recorded, right? So if you have joined midway through the Q&A, and you've missed Sana's presentation at the start, you can always watch it on our YouTube channel at your own pace. So thank you again for attending a Be Informed session. It's been a pleasure sharing this information with you today. The one-page handout will be sent through to you if you've registered by email. So if you haven't registered, please feel free to reach out to me and I can share that with you directly. Our next session is on the 28th of August. That's a Monday at 6 p.m. And we'll have a seminar on preparing tips and traps for preparing your FY23 tax return. So if you're interested in learning more about that and you haven't got to your tax return yet, and you haven't engaged an agent because you haven't got that extra time period to submit it, then you might want to attend it and learn some tips and traps. And that brings us to the end. Please do follow us on our social media sites and our channels, and continue to promote, in your networks and among your friends and family. Be informed. We do try to make sure that these sessions are contained and quick and easy to sort of understand, so you can always learn something and be informed in your activities. So on that note, we'll close it there, and thank you again, Sana.
Thank you very much, Carl. Thank you for the invite.
Thanks. Bye for now.